All right, urgent real-time Bitcoin, crypto, everything forecast. Everyone's talking about open interest right now. Silicon Valley Bank, I'll give you an update. Right now, open interest is back up again after one of the largest, actually the largest liquidation since FTX. FTX destroyed everybody's money and cost a lot for literally everybody. And then now we just had the second biggest liquidation since that FTX issue, clearing all the open interest, clearing all the leverage, longs and shorts, and now open interest is high again. What does that mean? How does open interest work, and does it give you an idea as to which direction price will go? Just by looking at open interest, you can't exactly tell whether there's more longs or shorts. You can't do that. Well, if there's open interest and price is going down, then that means that they must be in shorts. And if there's a bunch of open interest and price is going up, that means that no, that's not how it works. Open interest, it just means how many people are involved in longs and shorts. That's it. But for every dollar that gets shorted, you have to have someone that put a dollar long on close, or at least on the order books. You see how that works? You can't just have a bunch of people shorting and nobody putting up money to go the opposite direction, to close out or to go long. Because there's an order book. People put orders in, other people take orders. And if people didn't take the orders that were in the order book, there would be no price change at all. So the way open interest works, it just means how many people are putting how much leverage in. Now, that having been said, if you're a quant and you're a whale, you've got tons of money, and you notice that open interest is high, and you think everyone is shorting, like right now, it'd be reasonable that everyone is shorting. You're not going to want to short. Why? Because if everybody has all this open interest out, has all this long high leveraged shorts going on right now, then if everyone has high leverage shorts and you jump in with your mega whale money and you go high leverage shorts, then when you go to try and close, you have all that much competition. You have tons of slippage that you can't close on. You're not going to be able to close efficiently. You're going to lose a lot of money. You might not even be able to close because there's so many people trying to close at the same time. Price might wick down and go even higher than when you shorted, liquidating you. So you're not likely to put your big dollars on the line for a short at that point. What you're going to do is you're going to say, oh, a bunch of plebs are going long. This is what I'm going to short because there's tons of short liquidity. There's tons of people going the other way. I can actually fit my huge phallus into this order book, is how you think. And that's true. You want minimal liquidity and you want to be able to get in, do the opposite that everyone else is doing. Because if you're going to sell a lot, you're going to need people to buy a lot. Okay? That's basically how open interest works and how margin works. But in this case, in this particular case, when USDC and when BUSD have both been attacked and both been destroyed by Wall Street and the US government trying to collect taxes on everything, this is obviously a coordinated effort. If you don't see a coordinated effort to attack stable coins in the crypto economy, you're a moron. So in this case, when you have stable coins that can't be trusted, and the media has already built in so much fear on USDT that people are even wary of USDT. If you look at CoinGecko, for instance, all the stable coins, they're all depegged. They're all at least at 98 cents, 97 cents, 96 cents. DAI, for instance, DAI, or Magic Internet Money, they're all under $1 now. So nobody wants to use a stable coin, so what are people doing? if they think everything's going to go down, but nobody wants to use a stable coin, well, how are you going to do a short or a long in the markets right now? Well, you do a coin margin short or a long. So what you do is you deposit Bitcoin, deposit Ethereum, and you short that. But what if you don't know whether it's going to go up or down? You just want the effect of going to cash. This is a technique that old big traders use. They just do a -1 leverage short. If you do a -1 leverage short, what that means is that for every Bitcoin you have, you're taking one short out against each Bitcoin that you have. So what ends up happening is it's like going to cash. If Bitcoin falls 10%, your Bitcoin loses 10% of its value, but the short that you had gains 10% of its value. So you're at zero again. Ding, ding, zero. So a -1 leverage Bitcoin short or -1 leverage Ethereum short would make you absolutely no money in either direction. It's just like going to cash without using a stable coin. Ta-da! Okay, but wait, didn't you just say that if a bunch of people use a stable coin going short, then the whales are likely to not go short? So what about this in this case where a bunch of people went short, but they didn't actually use any real leverage? They only use -1x leverage to go short. In cases like this, since funding rate, in other words, interest rates, hit your account every 8 hours or so. Different exchanges are different. FTX was like every 2 hours or 1 hour, 30 seconds or something stupid like that. The amount of money, let's say you deposited 10 Bitcoin. You're getting billed every 8 hours, 0.0008% or something, 0.08% or something like that on your money every 8 hours. If that happens, you're losing Bitcoin value while you've got a 1x short on, except for the fact that even if the price of Bitcoin drops, the liquidity is going to be the same. There's not massive liquidity. There's not a massive liquidity shortfall. In other words, the order books aren't going to be that packed with shorters trying to close because everyone only did a -1x short while open interest is high. So let me explain this to you a different way. If you normally what would happen is you would deposit a Bitcoin and then you would short 10 Bitcoin. So at the end of that trade, you would have to close 10 Bitcoin or long 10 Bitcoin again. And the whale, who's got 5,000 Bitcoin, would need to long 50,000 or 100,000 Bitcoin while you're trying to long your 10 Bitcoin to close out. In this case, that's not the case because nobody has high leverage. It's just -1 leverage. So there's not hundreds of thousands of Bitcoin trying to close out if there's a dump, which means that even though there is a high open interest right now, a whale would look at this and say, doesn't matter. These guys aren't going to try and close on me. These guys aren't going to compete for order book liquidity when I'm trying to close out my huge short. So what I'm trying to tell you right now is that this would be a good time to short. There is a chance that we're going to get a quick green dildo up, a fake out wick that goes up, in which case I'm going to get liquidated because I've already got a short. But I'm using small enough money, calculating for the fact that I can get liquidated right now. If I'm right and we go straight down from here, I make a ton of money. If I'm wrong and Bitcoin or crypto goes up a little bit, I lose a very little amount of money. It's always worth the risk when you're dealing with a low risk, high return situation. By low risk now, I don't mean that the risk is low. That means that the risk to me is low. When you reduce risk, this is something that most people don't understand. Risk is not just a high number. I could do 100x long or 100x short and have zero risk. Right? I mean, that's possible, right? No, if you do 100x, it's absolutely risky. You're gonna no, but what if I'm friends with like Jerome Powell, and he told me that he's going. This is what he's going to say. I do 100x long or short, and I know exactly which direction the price is going to go. Zero risk. So risk is a function of knowledge. Risk is a function of position with knowledge. Risk is a function of uncertainties. So risk is not just the number of on your leverage. So you could have a high leverage, low risk trade if your knowledge base is huge to offset the number, the 100x leverage volatility or the risk there. Your level of alpha knowledge that you have. And you can also reduce risk by just reducing the amount of money that you put in. That's what reducing risk is called. But you said to reduce risk, why are we still doing 100x? Just use less money. That's how you reduce risk. You can reduce risk by using less money, or you can reduce risk by using less leverage, or you can reduce risk by adding more alpha. Subscribe to this YouTube. I'm going to give you more deep money making, how to get rich like a badass content so that you can get rich with the rest of us. Bitcoin-signals.org for all my signals 24 hours a day, what we're buying and selling. 24 hours a day, 7 days a week. But for the big updates, subscribe here.